Welcome to the daily update, where I'll go over the action in the market for Wednesday, February 14th, and then we'll see how things look for Thursday, February 15th. We had a nice little rebound. We still have some ground to regain, but growth is holding up. We're bouncing back up a little bit. The small caps had a pretty good day. It doesn't look, at least to this point, like we're falling apart. It looks like, if anything, we are in a pullback, as the broader market still remains more positive. But as always, there are some things that we need to be aware of. So let's go back and talk about what happened. Right at the open, we had a gap higher open. The futures were quite strong. We got above R1 at 49.76, and then prices fell below R1. We almost got down to the unchanged level. That's that built-in support or resistance level. When we're having an up day, it ends up acting as support. We didn't quite get there, but prices started to go back up before they reached that level. As the day went on, we were really choppy. We chopped back above R1, and then we ended up going a little bit higher into the close. That was more sustained, and we closed right at 5,000. How's that for a pretty interesting close? We were up 0.96%, so we gained back the majority part of what was lost in Tuesday's session after CPI came out. But we were below average with volume. That is something to be concerned of. We saw above average volume when everybody was reacting to CPI. We have a recovery day and volume is tapering off. Just want to be aware of that. We are positive with our technicals. So far, we're maintaining support above the 20-period moving average. We're maintaining support above that trend line, and I'll show you all of this as we go through the charts. So things are holding up. Growth is still hanging in there for right now. We're going to get a whole list of economic reports in Thursday's session. The biggest one is probably going to be retail sales, since that's such a huge part of the U.S. economy. And then in Friday's session, we'll get PPI. We do keep an eye on the different geopolitical events. Some comments. We closed right at 5,000 as lower support levels, at least for right now, are holding. Small caps had a pretty good day. And this is a little different than what I'm used to. They went back and they readjusted the seasonally adjusted indexes for the PPI looking at December, and they changed that. This isn't really announced. There's no report that comes out, but this information hits the market, and this happened a week ago with CPI, and the market liked that, and that gave us a real thrust higher. Well, the same thing happened in Thursday's session, where they revised things to actually being lower than they thought before, and the market positively reacted to that. They took the PPI for December, and they said it was down 0.2%, where it had been down 0.1% when it was reported. And then we had some Federal Open Mouth Committee speak that came out. The Chicago Fed President Goolsbee, who's not a voter, said that the Fed should not wait for inflation to get to 2% over a one-year period before cutting rates, adding that the CPI data is at odds with market data. That's taken as more dovish for the market, and the market liked that, and that gave some support. And then this is a headline that I ran across. We just want to keep an eye on different economies throughout the globe, because they can have a real impact on the U.S. economy. And apparently Japan's economy has now slipped into a recession. It's the definition that's being used, that they've had negative GDP for 2 quarters now. And this is being attributed to weak consumer spending. We still have the stochastics that are looking extreme positive in the short term. And then with the up day, we were kind of right on the border with some of our indicators. We're still keeping an eye on the oscillators. There's some positive things in our oscillators, and there's some negative things, and I'll go through that when we get to that chart. The Sean trend meter did tick back up, and then the Boom 50, which measures how far is the S&P away from the 50-period moving average. We're getting a little extreme there again. Long term, because we had the up day, we're looking at being extreme positive with our 150 and 200 period simple moving averages. The parabolic SAR chart is still negative. It has not switched back to positive. It takes more for that to move than just the upward movement that we saw. So we'll be keeping an eye on that. And personally, I think this is a pretty important indicator to watch. We're still dealing with this scenario that it does look like the Fed may be done raising rates. They may cut rates at some point in the future. Now the big debate is, when is that going to be? The dollar was down and interest rates were also down. This gave some support to stocks. We closed at 4.27% for the 10-year yield. We still have the yield curves that remain inverted that we've been watching for a long time now. Sentiment did tick back up. We had been at 69. We climbed back up to 73. The 75 level is that extreme positive reading. Now, after Tuesday's session, we were on the way down with sentiment. Because of the update, we're going back up. So the context has changed just a little bit there. When we're looking at our trend, we are positive. The green line's on top, but we're still dropping below the moving averages, both with the short and intermediate term ADX charts. We are positive with our bias because of the update. And right now, I'm keeping our momentum at mixed to positive because of the strong down day that we had. Also, because of the days that we've been going up, we're seeing a decrease in volume. So that's a little bit tentative for right now. We just had the MBNA Mortgage Applications Index. We get that every week. It was down 2.3%. Last time it was up 3.7%. Mortgages were down 3%. Refinances were down 2%. Here's a chart just showing how it has tapered off. This is a pretty volatile indicator, but we just want to keep an eye on this, because buying houses and having mortgages are a pretty significant part of the U.S. economy. Just one chart to show you here from Isabel Net. I show this from time to time. This is going back over a 20-year period of time and measuring, okay, looking over here on the left, this is the range, looking at the PE ratios of what they usually are and what it is right now. So this is suggesting, with U.S. stocks anyway, that we're still looking expensive. We're also above that 20 level. We tend to use a 10, 15, and 20 scale. And then looking at the U.S. stocks, we're at 21 right now. And then we can compare that to other areas throughout the globe. And the U.S. is still in first place. I'm not sure that's a good thing, but they're looking just a little bit expensive when we look at this chart. Here's our intraday chart where we did gap higher up above R1. We didn't make it up to R2 right off the bat. We kind of stalled out, came back down, and then we chopped below R1 for quite a while. We tried to climb up above it. That failed. But then it was a little bit more positive. Near the end of the day, we saw more of a sustained buying session going on here, where we were able to close right up at R2, right at 5,000 as well. Here's the intraday chart where we were bouncing around a little bit in the initial overnight session, but then once Europe kicked into gear and we got into the pre-market session, this is where we started to see some strength. And I watched this, even when the market's not open, and they were looking quite positive, and we carried that over into the cash session. Here's the choppiness that we saw within the cash session, the strong close, and then we're pretty much going sideways in the initial overnight session here. Looking at growth versus value on two independent different charts, or different measurements on the same chart, where we're seeing the blue line going back above the red line. So growth is holding up on this chart, at least for right now. We're also holding up when we look at it on a value rate basis with a 10-minute intraday chart. When I was watching this quite closely, we opened up and this went up, and then we saw that pullback not long after the open, and that was growth just getting hammered. But we came right down to the unchanged level and then spent the rest of the day going back up. So this is also suggesting that growth is holding up, at least for right now. Looking at our end of day charts, growth with the large caps was up quite a bit more than value. Also for the mid caps, growth outperformed, and it not as much, but it did outperform for the small caps. So where we saw all red on this chart after Tuesday session, for Wednesday session, it's all green. I'm not sure how that fits into Valentine's Day. This is more Christmassy here. But looking at the small cap growth to value ratio, we're continuing to go up. So this is also suggesting under the surface that we're seeing some strength here, even though it's not necessarily being reflected, at least yet, in the index. We also saw a turn back up when we look at mid-cap growth to value. That's going back up and showing more of a sustained uptrend. Again, even though it's not really being seen yet in the index. We also turned back up when we look at S&P growth of value. That's also looking more positive, but we haven't come back above this previous high yet. Keeping an eye on discretionary versus staples, that's also going back up and starting to break out. So we're seeing some improvement here. Keeping an eye on our trend, we are dropping below the moving average. The green line is on top, so we still default to positive. This is still a trending environment because we are above 20, but it could be a weakening trend. Here's the short-term chart, also below the moving average, green line on top, but still above 20. We are continuing to drop off here when we look at volume taken over a number of days. We did drop back down to below average. Here's a look at sentiment. We're still going up a little bit with the Ulcer Index. With the update, we declined with the VIX when looking at the line chart as well as the bar chart. We're also seeing the VIX of the VIX taper off here with the bar chart as well as the line chart. And we did decline with the equity put call ratio after it spiked up due to the decline that we saw on Tuesday. It came back down on Wednesday. So we're still declining when we look at our 5-period. That is still positive for the market. We're still keeping an eye on the VIX to S&P correlation. We're getting back up close to this dashed line again. We came down. That is typically negative for the market. Now we're starting to come back up again. We haven't quite crossed above this extreme reading yet, so we'll just be watching this chart. We're still up in the red area here with the skew index. The market is still anticipating something kind of big happening. And then here's the latest reading from the Investors Intelligence. This measures sentiment, and we're getting above this 3 level. Now, we could go higher than where we're at right now, but when we get above this, this is when we start to use this as a potential contrarian indicator. We did show a little bit of an improvement with the advanced decline line based on price, but we're lagging a little bit here based on volume. It turned up. See how volume is closer to price is closer to breaking out, where volume is still not quite there yet. We did see an expansion of the new highs and not really an expansion of the new lows, but we're still declining with our 5-period and our 10-period moving averages. We're still above 0 with the advanced decline ratio. Now with the cumulative NYSE advanced decline line, since we had the update, this is really starting to shoot back up, and we're seeing some improvement when we look at our regular NYSE advanced decline line. But we're also seeing a little bit of a lag here. We're showing a bit more of an improvement when we look at common stock on the NYSE. Hasn't broken out yet, but we saw more of an upward move where it's lagging a little bit here when we compare it to volume. A little bit of a concern. But when we look at the smart money, accumulation distribution is still looking pretty strong. The chicken money flow, another smart money indicator, is also looking pretty good. And we're turning back up and looking just a little tiny extreme with the chicken oscillator. So this is showing that the smart money is in there doing some buying. And you combine that with at least the fact that growth is holding up so far, it is still some positive things to take away. We did see an improvement with the NYSE advanced decline line when we compare it to the bar chart of the S&P. So we turned back up with the common stock with our advanced decline line studies, but we haven't broken out yet. We are showing a bit more of an improvement with the S&P. We improve with the mid caps as well as the small caps. Here's our daily chart. We're still above this upward sloping trend line for right now. This level has been providing support. On the bottom, it may be a little difficult to see, but we dropped to below average in Wednesday's session. And then where we look at a rate of change from one day to the next, we went extreme negative in Tuesday's session. Well, with the upward move, we're just barely looking extreme positive in Wednesday's session. We're also keeping an eye on the 20-period moving average. When we fell down, this level held as support. And for right now, anyway, we're bouncing up off of that. If we see some more weakness, we'll still be watching this 20-period moving average. We ticked back up a little bit with the 20, 50, and 200-period moving average study. We're looking a little more positive. We were right about at the 0 point with the force index, and we did go up, but we're still below a declining midpoint. We're no longer extreme, but we did tick up in the short term with our stochastics. We're no longer extreme and declining in the intermediate term, and we're rolling over and still extreme positive in the long term. And we're not extreme right now with our standard deviations chart. We're in the +2 channel. It's when we get into the +3 channel, that's when we've gone up a little too far, too fast. The force index, the balance of powers continuing to be above the midpoint and advancing. That's positive. We're still looking at a lighter shade of blue here. We have dark blue when it's more positive. When it turns to lighter shade of blue, is that a Procol Harum song or something? That's where it's positive, but it's more of a neutral positive. And we're still staying above the midpoint with the highest high value. The TTM squeeze is turning back to a lighter shade of blue, also another Procol Harum thing here. So that is turning a bit more positive. We're turning back up with the ease of movement with 14, based on the 14 period study. And we're no longer extreme and actually declining with the Arun. We're still below zero with the S&P McClellan oscillator, but we did bounce back up. So we continue to decline with the summation index based on price. That's a longer-term negative divergence that we've been seeing for a while. We also are continuing to decline with the summation index based on volume. So that is contradicting the move up that we've been seeing. But when we look at the broader market, the NYSE McClellan oscillator is still above, or it went back above zero and is actually turning more positive. We're trying to turn up with the summation index based on price and volume for the NYSE. We declined with the Swenlin trading oscillator, but we're still above zero based on price and volume. And this is where we're seeing some real contradiction here. We're rolling over with the PMO, but we're still extreme positive. We still have yet to cross above the moving average based on price, and we're still pretty much flat based on volume. So this is not showing that there's an awful lot of strength. We bounced up a little bit with the PMOs that are rising. We're declining with the buy signals, and we're more in a sustained decline with the PMOs that are above zero. We continue to be neutral with the Elder's Impulse system for the S&P. The dots are still on top with the parabolic SAR. Now, this happened back, it was December. We were chopping more or less sideways enough to put the dots on top, but that lasted for 2 days before we ended up going back positive. We have no idea how long this is going to last, but just because we have 2 days here doesn't mean that it's going to last for a long period of time. This reacts to price movement, and if we see a nice little upward move here, the parabolic SAR may change. If we see sideways action to declining action, the dots will probably still stay on top. We are rolling over a bit here with the slope oscillator, even though we're extreme positive. We're also rolling over with the MACD. You could start to make a case that we're seeing a negative divergence now as things are unfolding a little bit. Right at the end of 2023, we were going up with price and setting a pretty high value with the MACD. We continue to go up, but we haven't surpassed that high yet. Now, and I know a lot of folks just love to really attach themselves to these things. These are moving averages and they lag. And what's used in the moving averages are different than what we were using when this was really going up. And so we can't help but get a negative divergence. So sometimes it's not so much that this is giving us insight, it's that millions of people are seeing this, and this ends up producing a self-fulfilling prophecy. But for right now, it does look like we might be seeing a negative divergence. And we're seeing that with other oscillators too. The slope oscillator is turning down and never got back to this previous high, as well as the TSI. We're rolling over a little bit with the MACD, and I already pointed that one out. We're also seeing a bit of a negative divergence with the PPO and the PMO, but we're still going higher when we look at our longer-term oscillators, the TRIX and the KST. I guess we're rolling over just a little bit here with the KST, but we haven't quite crossed below the moving average. We're still holding up as far as our 20-period moving averages here, and we're still declining with the bullish percent index. That's another warning sign. We had an up day with the S&P. This ended up declining slightly. We're also coming down just a little bit with the NYSE bullish percent index. We ticked up a little bit here with the NASDAQ 100 bullish percent index, and we're just coming off of being in the above 70 for a long time. So this is still technically on a sell signal. We're no longer extreme with the money flow index. We turned back up with the ultimate oscillator, and we're above 50. We're ticking back up a bit with the vortex, and the green line is on top. We turned up with the RSI based on 14 and 9 periods and not extreme, and above 50 still. We're still looking positive with the on-balance volume. We ticked back up with our 200-period moving average study for those stocks in the S&P, but we're still seeing a longer term negative divergence here. We also turned up with the 50 and we're seeing a more pronounced negative divergence down below. We're still rolling over with the Copic curve and turning more negative. We ticked back up into the initial extreme area with the Sean trend meter. And we're seeing kind of a doji candle right now with the Heiken Ashi. That means we opened and closed it right about the same spot, so it's a little indecisive. We've turned back to more positive now with the Kegi chart. We're black and we're pointing up. Where the Renko chart, it's like, what? Something happened on Tuesday? I never saw it. I'm still going to stay positive. We're still looking a little more negative with the 3-line break. So we're not seeing real uniformity with our chart variations either. We're starting to get extreme with the 50. We're not quite there with the 20, but we've come back up and we're getting kind of far away from the 50-period moving average. We are showing a bit of an improvement when we measure the distance from our 200-period moving average. Here's the trend line that we've been watching, and this has been really holding up as support. We broke down below it in Tuesday's session, only to close back above it. This ended up marking the low in Wednesday's session, and we were able to bounce up off of that and close near the high for the bar. And then looking at the Keller market model, I changed the typo that was here. We're green across the board, across all different time frames. When we look at the S&P, mid caps, small caps, and NASDAQ 100, here are the alerts that were triggered. We saw that the NASDAQ, it was all chopping above and below different levels right now, but ended up being positive by the time we got into the close. And the S&P is it's at 5,000, but it's 5,000 and change. So that counts as a cross above 5,000. We're still hanging in there with the equal weight when compared to the S&P weighted index. And we came down, actually, we came back up just a little bit here with our ratio after it had been declining. So this is holding up at least for right now. The Dow was up, and you could call this an inside bar because we didn't exceed Tuesday's high or low. But the fact that we did bounce after having a pretty significant down day is I guess you could say positive there. We've switched from being negative to neutral with the diamonds for the Elders Impulse system. We came back above this R1 level with the NASDAQ. So we're recapturing some support there. We're coming right up to this R1 level with the NASDAQ 100. We haven't quite closed above that yet. And we still remain neutral with the QQQs when looking at the Elders Impulse system. We're still dropping below the moving average with the PPO. So when we look at the NASDAQ 100, the momentum continues to be negative. Small caps had a pretty good day. They still have a ways to go to get back to this R1 level, but they were able to recapture the pivot level and their 50-day moving average. And we've switched back over to positive with the Elders Impulse system for the small caps. And when we look at the Russell 2000 small caps, we're back above this resistance level again. So that is encouraging. We spent a couple of days above it, then we dropped below it. Now we've been able to recapture that. And we recaptured this pivot level for the mid caps. So that's showing some improvement there. We've gone from being negative to positive for the mid caps from looking at the Elders Impulse system. We did bounce up, but we did not set a new all-time high with the FANG index. We were up with the financial sector, so that continues to hold up for right now, where we saw a little bit of a bounce over 1% with New York Community Bank. The dollar continues to go up and is above both of the lines, and we're starting to see the blue line turning back up. The longer we can stay above this, the more we might see a golden cross here. And the dollar, by the time we closed, it ended up being down. This is the after hours when it was ticking back up just a little bit here. And so that helped give a little bit of support to stocks. Keeping an eye on the 10-year yield where we did drop, that probably helped stocks the most. We did tick back up after coming down to the 200-day moving average when we look at bonds based on price. This is a chart from Isabel Net, and you can take this. These crazy swoopy lines and different types of trend lines that seem to kind of come from out of nowhere. I'm not a big believer in that. You might want to just pause this and see, okay, is this in fact a head and shoulders bottom? Yeah, there's some validity to all this stuff, but I've seen it fail just as much as I've seen it succeed. To me, you have to get too subjective with this. You have to read your own interpretation into this, where I like to be more objective. I like the charts to just be quite blatant and just tell me, okay, this is what's happening right now. You don't have to do a lot of your own interpreting and even translation into these things. So, but I wanted to include this because some of you might find this helpful. Looking at growth versus value, we're pretty much right on the moving average when we compare the Qs to S&P. We turn back down with discretionary to S&P, so this is still a bit of a concern. We're turning back up when we compare large cap growth to large cap value. So with the large caps showing some improvement, mid caps, and the small caps, this is really giving us some hope. We're not really seeing it with follow through with the indexes, but we are seeing it more internally. We'll see if that can lead to the indexes actually going higher. We're still positive when we look at the 5-period moving average of the highs minus the lows and then measure that across the Amex, NASDAQ, and NYSE. We are going up with the S&P to utilities ratio, and we are going down when we look at the staples to S&P 500 ratio. So these are positive things under the surface. So what's our outlook for Thursday? We're positive and we're bouncing back after a decline. We're getting some mixed signals, but for right now, support is holding. We want to keep asking this question. Are we seeing weakness develop? There are some things that are causing us some concerns. Here's a whole list of things that are going to be coming out. We'll get the weekly jobless claims. Retail sales is going to be the biggest. Import and export prices, the New York Empire State Manufacturing Index, the Philadelphia Fed Index, industrial production and capacity utilization. To me, this is another important one. Business inventories, the NAHB Housing Market Index, that comes out every month. And then we're watching all the different geopolitical things that are happening. And then in Friday's session, we will get PPI that is going to be released seasonally. And I have a few new charts and some updated charts here. When we look at February 15th, we're positive across the board with all of our indexes. We're also in the week of options expiration, which tends to be up a little more than down. Here's an updated chart here. It says the 4th year of a new president tends to see the most of the gains later on. This is that possible negative seasonality that we see coming throughout the middle part of February down into the middle to latter part of March. Just to be aware of that. Even when we end up having a really good year, it doesn't mean that we don't, again, that's a double negative. We can still see some weakness when those things happen. Here's the Stock Traders Almanac statistics. We're kind of coming down, possibly, at least on a time basis, where we could be entering a period of weak seasonality. This has also been updated. You see where the purple line, we're getting a long ways away from the the green line here. And even if we come down with this, we could still be positive seasonally, but because we're so far away from what historically has happened. But what I really focus on here is the green line, where we often see some weakness going into the latter part of February, maybe a little bit of a bounce in early March, and then weakness going into the middle to latter part of March, where February is the weakest of the best months, even during an election year. Thursday tends to be a positive day when we compare it to what happened in 2023. We will be on the 11th trading day of the month, where we do see this sloping up just a little bit for the S&P during an election year. And I got this like a week ago, and I've been forgetting to include it. I put it in one of the weekly videos. This is Tom Bowley's research for the month of February, where overall he sees it as being bearish, where the first part of the month we were positive, and that's kind of... Then we're hitting this time of weakness. Now we're coming into the period where we do see some positive seasonality, where it turns more negative going into the latter part of the month. Just something to be aware of. And this is research that he did based on the S&P 500. So our scenarios, not really going with the down one right now. Our technicals are positive and we're still bouncing after a decline. If we do start to see some seasonal weakness, we want to see it confirmed by our charts, and we're not really seeing that yet. If anything, we're leaning back more towards the positive side because our charts are still tending to be positive. We're not going with the sideways trend because even though the ADX charts are below their moving averages, they're still above 20. One thing that seems to be kind of consistent now is volume has been decreasing as the S&P has been moving higher. That's a bit of a warning sign. The risk on risk, it's just not helping us now. Our S&P 500 oscillators, they are extreme positive and they're dropping below their moving averages. But now we're starting to see some negative divergences develop. It may be logical or illogical, but a lot of people see these negative divergences and act upon them. The McClellan oscillators and summation indexes are negatively diverging. That's longer term. The parabolic SAR continues to be negative, and the Copic curve is also negative. The NASDAQ 100 bullish percent index is below after being extreme positive. And we're looking more negative when we look at the momentum, basing that on the PPO for the NASDAQ 100. Small and mid cap growth. Okay, let me try that again. Small and mid caps are negatively diverging from the S&P. We're close to all-time highs with the S&P, Dow, and NASDAQ 100. We're not even kind of all that close when we look at the small caps and the mid caps. The discretionary sector showing some improvement, but it's still diverging from the S&P. The transports longer term continue to negatively diverge from the Dow and the S&P 500. We are possibly entering a period of weak historical seasonality here. Positive signs for right now, growth is holding up, and you can see that in the small caps, mid caps, and in the S&P. The S&P 500 oscillators are extreme positive, okay? And you can't get more positive than being extreme positive, but sometimes that marks a reversal there. The equity put call ratio based on 5 periods is still going down. The vortex is positive. Small and mid cap growth is still hanging in there and showing some improvement, for at least for right now. And the financial sector is positive. So our conclusion, we're still positive. We're bouncing after we saw a decline, but we still want to ask this question: is weakness developing? Not only based on what we see in the charts, but what we see historically when we look at seasonality. In the short term, we're asking that same thing because that's where everything starts, is in the short term. Intermediate term, we are positive, but we're still kind of showing some weakness after we had been overbought. We're still positive in the long term. We're a little bit overbought now. I forgot to put the OB here down at the end of the sentence here because we're looking extreme with the 150 and 200 period moving average study. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.